A. Balasubramaniam, CEO of Birla Sun Life AMC, is also joining in this discussion now. Bala, morning. Before we talk about your view on the market, perhaps you could update us on what's been happening with redemptions in the fixed income side. Have you seen a lot of that in the last 2 weeks?
Not really in terms of the quantum of redemptions. Largely the redemptions were in the nature of liquid fund redemptions. That was there immediately post the RBI move, which was on a Tuesday, making some changes in terms of the interest rates to go up at the shorter end. During that period, the whole of that particular week, there were some redemptions, which could have been to the extent of about 60 to 70,000 crores, approximately, from all mutual funds put together. And unlike the last time, 2008 crisis, where the redemptions were quite substantial, that was largely on the premise that credit quality of the portfolios in the mutual funds could potentially pose a threat on their capital. Whereas this time around, that kind of panic was not seen, and the redemptions were largely on the expectation that in the short duration funds, especially the money market funds, in India is called as liquid funds, had to give negative return for 1 or 2 days, given the fact that swing in the rates in the short term was substantially higher than what we call it as a tolerable limit. The moment it happened, yes, there were some redemptions, but again, that segment of the business is coming back to normal.
Do you think the redemptions may not have happened in longer maturity products because people were too frozen? The movement of the yield was so sharp, and if the yield does retrace back to 8% over the next few days, do you expect to see a lot more people redeeming now that they have been stung by the prospect of the volatility in the gilt market?
Yeah, I think clearly one other thing which I am seeing after seeing the industry for so long, this time around, the level of maturities, the kind of reaction that is coming to the entire move, and the portfolio, the value changes, which I would call it as a negative return that is being generated. The tolerance has been relatively higher, as you rightly mentioned, for the simple reason that the swing from yield on 10-year bond yields going about 1% and corporate bond yields going about 1.5% the longer end, the portfolio has got the hit then and there. I think the immediately got reflected in the portfolios in terms of valuations. So that is, in some sense, of course, would definitely hold back the investors. Even what we also been suggesting is that while one can, of course, get worried about what's currently is happening, given the fact that the view that has been taken by RBI is to more to control the volatility in the rupee dollar movement, and as and when we see actually a stability, which could be maybe 1.5 months, we will see actually the bond deals coming back to normalcy. Once it comes, what could probably change in our view is, though the long-term views may remain somewhat benign, at the same time, when the portfolio gets adjusted, we'll probably see a bit of an allocation towards from longer duration to the short durations, and probably a larger allocation to the money market funds, and that's the kind of shift in all probability could happen. At the same time, we could also see a shift happening towards accrual kind of product, where probably I'll be able to reasonably estimate what could the potential return it could get over the next 1.5 years time frame. The fact of the matter is, where there is high realization which is there, I think that's the beauty of always the fixed income. In a money market fund today, with the yields going up, the portfolio yield also keeps rising because they're all mark to market on a daily basis. And today, if you look at the portfolio yield, is close to about anywhere around 11 to 11.25% for a 60 days maturity. Clearly indicates that anybody who come in, who could only potential gain what will get will be a little higher. So which essentially also means that the existing investors is as good as selling the instruments at 11.25%. The question to ask is it worth doing that? That's why I think there is a high level of tolerance and a high level of what I would call it as a maturity that is there in the minds of investors this time around, given the fact that portfolio has taken a hit, but portfolio yield is high, which is not the yield at which one should sell.
Bala, how are you treating it as a fund manager in your large diversified funds in terms of your exposure to the outperforming sectors like FMCG versus recent underperformers like banks?
Yeah, I think the way we have been constructing the portfolio for the last many years, and especially the last 3-4 years, since the time there has been a high volatility which we are witnessing on either the commodity sectors or any other sectors which could have in some sense in governance issues. The way we have done it, one is mapping to the index with respect to the weightages and to what extent you should go underweight and overweight. You cannot afford to go zero in any sectors. At the same time, to what extent you can go underweight, and to that we of course decide. On the basis of that, if you look at it, we have been underweight on sectors like FMCG to some extent, given the fact that the valuations are stretched. At the same time, the largest sectors within the both in the Sensex and Nifty is the banking and financial services business, and which has been of course a sector which has been very tricky, affected by the economic slowdown and as well as high level of rising NPAs and so on and so forth. And this is the sectors where the large proportion of the selections have been more towards something which is highly focused on retail, not so much on corporate books they ran, and which you could reduces the potential threat of NPAs, and that's why we have allocated, which essentially means that private sector banks. And within the private sector banks, of course, at the post RBI move, though they have got corrected for the reason that one, interest rates rising scenario could impact their deposit mobilization capability, thus increasing their cost of borrowing. But having said that, at least the fear of the NPAs, the fear of capital adequacy, and the fear of reducing ROE and ROA, the threat is not there. To the extent we of course go and have a larger allocation to that sectors. That's the way we have built the portfolios. And then the entire motive is not to of course try and actually significantly outperform the market, and target actually the marginal outperformance in these kind of occasions. At the same time, reduce the portfolio volatility by having exposure to some of these sectors which could have least potential impact in this kind of volatile scenario, especially from the results point of view. And as a fund house, gone a little bit underweight for a very long period of time in public sector banks, given the fact that the valuations are cheap. Always the question mark what we raise internally, the valuation cheap may also lead to a valuation.
Bala, how would you have approached this one? Because these stocks form a part in most equity portfolios for mutual funds.
Yeah, though fortunately, of course, we don't own these stocks big time in any of your portfolio, given the fact that the sector at this point of time, though they have been throwing up a lot of cash, but given the uncertain the economic environment, we have been underweight on sectors, especially on including cement. Having said that, I think the announcements which is come from in terms of merger, to what extent is not been fair to the shareholders, one need to be assessed and analyzed before we react on that.